Hi, I'm Dr. Cheryl Dunn, and I'm here to discuss acquisition cost of operating assets. At the time that a company acquires an asset, they need to include all costs that are necessary to buy the asset, bring it to the company's location, and preparing it for its intended use. So the costs will include the purchase cost, sometimes known as the invoice amount, any taxes that need to be paid for the purchase. If the property is real estate, there might be back taxes that have to be paid. Those would be considered part of the cost of buying that real estate if we had to go pay some back taxes in order to buy it. Transportation to the company's location. Any setup costs for the asset. If that's part of preparing it. For its intended use. If it's just an ongoing setup cost that needs to be done every time the asset is used, so for example, you set it up one way if it's production equipment to produce one product, and then you have to change it and set it up a different way for another product, that would not be part of the asset cost. That would be part of the production cost. Let's see, if you had to demolish some existing structure in order to make it usable for its intended purpose, that demolition cost would be part of the cost of the asset. So for example, if we bought a tract of land that we wanted to build a factory on, and there was a house on that building, or on that land, and we didn't need the house for anything, didn't want the house for anything, it was just in the way, demolishing or removing that house would be part of the cost of buying that land on which to build our factory. If there is any salvage of that demolished structure. In other words, if we're able to remove the house and sell it, or we're able to remove some of the wood and the bricks and we're able to resell those, that would actually reduce our cost of the asset. So anything that it costs us will add to our cost, but anything we're able to get as proceeds from what we salvage, that will reduce our cost of that asset. So I should point out, these are all things that add to the cost. If we have to pay for insurance while it's in transit, to the company location, that would add to the cost. If we have to pay for attorney fees, or realtor fees. Usually realtor fees are paid by a seller of an asset, but occasionally a buyer might have to pay some as well. So those would increase the cost of that asset. So we talked about some of the things you should include in the acquisition cost of a long-term asset. Now let's talk about what are some of the things you should not include. Any cost that's not necessary. Such as, for example, a groundbreaking ceremony. As an example, it's just one of many potential examples that you could have. Also, any ongoing repair or maintenance cost. Now, if it needs repair immediately on buying it to get it ready for its intended use, that would not be an ongoing repair. That repair would be included. So, for example, if you bought a computer and it wasn't working properly when you bought it, and you had bought it used, and you needed to repair it in order to make it usable, that initial repair cost would be part of the cost of the computer. But from that point forward, any additional repairs that computer needed or any maintenance that it needs to keep it free of viruses and things like that, that would then just be an ongoing repair and maintenance expense. You would not call it part of the asset called computer. If there's ongoing insurance, if you've insured the asset against theft or damage for after it's installed, that would not be part of the assets cost. That would be insurance expense on your income statement each period, not part of the asset cost on the balance sheet. If you had ongoing taxes that you had to pay with respect to an asset. For example, if it's real estate, you may have property taxes that from the point of purchase forward, any taxes incurred on that asset then are going to be tax expense on the income statement. They won't be part of the asset cost on the balance sheet. Okay, so hopefully that helps you understand the acquisition cost components. Next, we're going to talk about what happens if you buy an asset as part of a basket purchase or a group purchase. Okay, when you buy multiple assets as part of a group purchase, it's important to determine separate acquisition costs for the different assets. So, for example, if you bought a parcel that included land and a building and some equipment, and you paid one price for the entire package, you would need to split that price into the three components. And so you would come up with a land price and a building price and an equipment price. And you're going to get those prices on the proportion of the value of each of these assets, the total value determined by some kind of an appraisal. And so, for example, let's say we bought this package for, let's say we paid $640,000 in total, and we had the assets appraised, and we were told that the land is worth $80,000. And we were told that the building was worth $560,000. And we were told that the equipment was worth $160,000. So on this basis of this appraisal, you'll see that these assets would be worth, let's see, 560 plus 160 is 720, 800,000. We only paid $640,000. We are not allowed to just arbitrarily decide, oh, we're going to put $160,000 as the value of the land, and we're going to put the rest split between the buildings and the equipment. We can't do that. We have to use this appraised value and the proportions to determine what portion of the $640,000 is going to be deemed as the land price, the building price, and the equipment price. So basically, we just take the proportions. So we would take 80 over 800 This is the proportion for the land. And so we would multiply that by 640,000 to determine that the land price is going to be deemed as 64,000. We would then use the 560 over the 800. That's the proportion that we're going to allocate to the building. And again, we multiply that by 640,000. 160 divided by 80 is 70%, and 70% times 640,000 is going to equal 448,000. And so that would be the price of the building. The equipment price, then, we would take the 160, we would divide that by 800, that gives us 20%, and 20% times the 640,000 would give us 128,000. And so that would be the cost we would deem as the equipment cost value. And we can double check ourselves by adding these together to make sure that they total the 640,000. And indeed they do. So that's how you allocate the cost of a group purchase to the different items. I'm not talking about allocating across time like we do with depreciation, but this is just distributing the purchase price across the different assets.